At the moment of generation on August 5, 2026, the stock market trading session is officially closed. Tilray Brands, trading under the ticker symbol TLRY on the NASDAQ, closed its regular trading session at $4.42.5 per share, representing a sharp drop of 4.63% on the day. In after-hours trading, the stock showed minimal movement, ticking slightly up to $4.43. While the general retail market looks at that 4.63% drop and assumes this is just another standard, painful pullback in the beaten-down cannabis sector, a much stranger structural shift is taking place beneath the surface. While everyday retail investors are hyper-focused on federal rescheduling rumors and legal reform timelines, Tilray has quietly transformed its underlying revenue engine into something that barely resembles a pure-play cannabis company anymore. Most retail traders using a typical individual brokerage or checking their Robinhood stock trading dashboard still evaluate Tilray through the lens of a North American weed producer. But if you strip away the branding and look at the actual cash flows, Tilray is systematically turning itself into a craft beverage and consumer packaged goods conglomerate. The consensus market expectation is that Tilray is trapped in a permanent death spiral caused by Canadian oversupply, regulatory delays in Washington, and persistent net losses. The reality, however, is that management is playing a high-stakes balance sheet game, using dilution to wipe out bank debt while building a massive alcohol distribution infrastructure that could act as a Trojan horse the moment international or U.S. markets fully open. To understand why the stock is swinging so violently between $3.67 and $4.65 over recent weeks, you have to dissect the psychological gap between expectation and reality. Wall Street expects a growth company to deliver clean, expanding net income margins. What Tilray delivered instead in its recent full-year fiscal earnings report was a massive headline record revenue figure of $915.5 million, up 11% year-over-year, paired with a brutal fourth-quarter net loss per share of 43 cents, which wildly missed consensus estimates. That single earnings print caused an immediate knee-jerk sell-off across online investing platforms, sending retail traders on Interactive Brokers and SoFi Invest scrambling to cut their losses. When a stock posts record top-line sales of nearly $1 billion, yet still managed to report a heavy full-year net loss of over $100 million, the market's initial reaction is pure revulsion. Algorithms trigger sell orders, shorts double down, and retail forums flood with panic. Yet, if you look closer at the intraday trading volume and recent order flow, institutional desks were not simply dumping shares blindly, they were absorbing liquidity during the dips down toward the $3.67 multi-month lows. Why would sophisticated capital touch a company posting negative GAAP net earnings? Because the balance sheet health has fundamentally decoupled from the GAAP earnings noise. Over the past year, Tilray managed to slash its net debt by approximately 95%, bringing it down to under $1 million, while building a cash and marketable securities cushion of roughly $235 million. That is a radical transformation for a company that was once burdened by heavy debt obligations and predatory financing. For investors using Fidelity Brokerage, Interactive Brokers Trading, or general brokerage accounts, this presents a classic dilemma. Do you value the stock based on its messy, write-down heavy income statement, or do you value it on its newly fortified balance sheet and growing gross profit? The short-term price action tells a story of intense friction between short sellers and value buyers. With a beta hovering near 1.89 and implied volatility elevated, TLRY remains one of the most volatile mid to small cap stocks on the NASDAQ. On high volume days, daily swings of 5 to 8% have become the norm rather than the exception. Much of this intraday churn is driven by macro sentiment surrounding interest rates and small-cap capital flows. When traders execute orders through the Robinhood app or active platforms like SoFi Active Investing, they are often reacting to momentum signals rather than fundamental shifts. But institutional money looks at sector momentum and strategic positioning. While the cannabis side of the business faces price compression in Canada, Tilray's craft beer and spirits segment, powered by brands like Sweetwater, Montauk, Shock Top, and Breckenridge Distillery, provides a steady cash flow buffer that pure play competitors simply do not possess. Comment below how many shares of Tilray Brands you currently hold in your portfolio and what your average cost basis is. To really understand how Tilray arrived at this pivotal junction, it is necessary to step back and analyze what the company actually does today versus how it started. Founded initially as a pioneer in medical cannabis research and production, Tilray achieved global notoriety during the early legal euphoria, peaking at astronomical valuations before the reality of regulatory bottlenecks set in. The current iteration of the business is the product of a massive reverse merger with Aphria, which effectively placed Aphria's management team at the helm of the combined entity. Today, Tilray operates across 4 distinct business pillars: cannabis production and distribution in Canada and international medical markets, beverage alcohol across craft beer, spirits, and ciders, a European pharmaceutical distribution network via CC Pharma, and wellness consumer products like Manitoba Harvest. Its core business model relies on leveraging economies of scale to lower production costs per gram in cannabis, while simultaneously building out a broad distribution footprint in non-cannabis consumer goods. In Canada, Tilray remains one of the market share leaders, but heavy excise taxes and hyper-competitive adult-use pricing have made domestic cannabis profitability an uphill battle. To counter this, management aggressively pivoted towards beverage alcohol, acquiring iconic craft beer brands from Anheuser-Busch and expanding into ready-to-drink spirits. The strategic thesis is straightforward: construct a nationwide distribution infrastructure in North America that can handle both traditional beverages today and THC-infused beverages tomorrow, assuming federal regulations eventually allow hemp-derived or cannabis-infused beverages to enter mainstream retail channels. Looking ahead to the future outlook, the narrative surrounding Tilray inevitably collides with regulatory expectations versus commercial realities. The broader market operates under the assumption that Tilray needs full U.S. federal legalization or DEA rescheduling to survive and thrive long-term. This expectation creates periodic explosive hype cycles where any news snippet out of Washington sends the stock soaring 20% in a single trading session, only for those gains to bleed out when legislative momentum stalls. However, the contrarian reality is that Tilray's survival is no longer strictly dependent on federal action in Washington. By building out its European medical cannabis distribution, particularly in Germany following recent legal reclassifications, and scaling its U.S. beverage alcohol footprint, Tilray is establishing a floor for its business that operates independently from Capitol Hill timelines. Management's guidance for fiscal year 2027 projects adjusted EBITDA between $68 million and $75 million, signaling that operational streamlining and supply chain synergies are expected to start hitting the bottom line. But risks remain very real. Continued share dilution to fund acquisitions or settle historical obligations remains the single biggest complaint among self-investing retail traders using online investment sites. Every time new shares are issued, existing equity is diluted, which caps explosive upside potential and creates heavy overhead resistance on technical charts. Furthermore, if craft beer sales slow down, or if Canadian cannabis price compression worsens, Tilray could face additional margin pressure that forces further structural restructuring. For long-term investors utilizing Fidelity investments, interactive brokers trading, or general brokerage accounts, the ultimate test for Tilray Brands comes down to execution versus narrative. The market has priced TLRY like a distressed penny stock, discounting its massive top-line scale due to persistent net income line clutter. If management can demonstrate consistent cash flow generation from its beverage and international medical units while keeping debt near zero, the gap between the market's low expectations and the company's financial reality could trigger a violent repricing to the upside. Conversely, if operational expenses swallow up gross profits and dilution continues unchecked, the stock will struggle to break out of its multi-month trading ranges. In summary, the story of Tilray Brands today is defined by the sharp contrast between short-term market disappointment and long-term structural repositioning. The market saw a headline loss and sold the stock down 4.63% to close at $4.42.5. But beneath that daily price movement lies a company that has erased almost all of its net debt, accumulated over $235 million